And then we take a look at current ratio. Okay, current ratio, that's how quickly we can transform our assets, okay, current assets into cash. Okay, and this is critically important. Okay, so in 2013, we take all the cash items or cash equivalent items. Okay, for example, we take cash and marketable securities. We take accounts receivable. We also take inventory. Okay, we can sell them for cash. Divided by accounts receivable and short-term debt, and we have 0.97. And we'll be taking in 2012, we take 72,000 plus 36,000 plus 108,000 divided by 43,200 and 141,957. We have 1.17 for the current ratio. And in 2011, we have 60,000 plus 30,000 plus 90,000 divided by 36,000 plus 87,300, 1.46. So this shows us the current ratio used to be very good in the past, but as the time goes by, the firm is actually not doing quite well in the current ratio performance. And the industry average, okay, is actually 2.0. So regardless of the 1.46 in 2011, which is better than all the other years, the firm is actually declining in its performance. Right, and then how about after the current ratio, we also have the quick ratio. Okay, this is also in the same category to analyze how a firm can quickly turn its assets into cash. Okay, in case of a company liquidation or company cash emergencies. Okay, right. So here we take 2013, we take the cash and marketable securities again, plus the accounts receivables. Okay, but this time we're not using inventories. Okay, and we also divide it by accounts receivable and short-term debt. Okay, so we have 0.49. Okay, for 2013. Now for 2012. We take 72,000 plus 36,000 divided by 43,200 plus 141,957, and we have 0.58 for the quick ratio. And then in 2011, 60,000 plus 30,000 divided by 36,000 plus 87,300, we have 0.73. Again, this is similar to the current ratio that we saw earlier. Okay, in 2011, it used to be very high. But gradually it would decrease to 0.49 in 2013. Now, how does this compare to industry average? Okay, as it looks, okay, 2013 the industry average should be 1.0, but for this particular firm, they're only meeting half of it. Okay, 0.49. All right, so it means that the firm, if there's an emergency for cash, the firm is unable to cover for its cash emergency needs. Okay. Which is very dangerous, right? Okay, so after the current ratio and the quick ratio, now we have the cash ratio, uniquely for cash. Okay, how much of the cash at hand the company has, that could be doing for the immediate payment. Okay, immediate payment, right? So we take only the cash and marketable securities that we can convert into cash without any time lag. Okay, so 86,400 divided by accounts receivable and short-term debt, 51,840 and 240,432. We have 0.324 in 2013. In 2012, we take 72,000 divided by 43,200 plus 141,957. We have 0.389. And 2011, we have 60,000 divided by 36,000 plus 87,300. That'll be 0.487. Now, noticing that there's a similar pattern as what we have calculated for the quick ratio and the current ratio. The firm is actually declining in its cash equivalent ratios, or what we call the liquidity ratios. Okay, so it's not highly liquid. All right, which is a warning signal. Okay, warning signal. So here in 2013, industry average as 0.7. But the firm is barely making it, okay? 0.487, 0.389, and 0.324, right? Okay, and here, how about the market price ratios? Let's take a look. We have the book to market, okay? Book to market, or the market book value ratio. This is what we have, market price of a share of the firm's common stock divided by the book value. Okay, that would be the original value of the firm. Okay, so the shareholder equity per share and a firm with a low market book value will be a safe investment. Okay, because the book value will be the original price of the firm. If the firm has been established for a very long time, maybe 50 years ago or 100 years ago, the book value should be low, okay? Because we're not taking into account of inflation, right? Or the future market value of the firm, okay? So seeing the book value as a floor supporting the market price, okay? How low could it be, okay? So it should be lower, okay, to be safer, right? And the measurement of growth opportunities, okay? If a firm had a value like this, how much of the future growth opportunity for the firm is, and then we can estimate, okay? So that's the PB ratio, Right, so let's take a look at one example. We have two firms, one with a book value per share at 10, both with a market capitalization rate of 15% and a plowback ratio of 0.6. Now, what is a plowback ratio? Plowback ratio is how much of a percentage from the retained earnings the firm will be taking away for other purposes. Okay, so in the retained earning, the firm must pay the shareholder equity. They must also pay for the dividend, and they must also pay for the additional investment projects. Okay, so that's what the plowback ratio is. Okay, and the plowback ratio, in general sense, usually at 60% or at 0.6. Okay, so here we have firm A. The ROE is 20%, so each share we earn $2. The dividend, we take 1 minus the 0.6 of the plowback ratio, okay? So what we have left, multiplied by $2 of the ROE per share, the dividend is at 0.8, okay, 0.8. Now, how about for the growth rate? Okay, the growth rate, okay, by taking the ROE multiplied by the plowback ratio again, so we have 0.6 multiplied by 0.2, it's 0.12, okay, 0.12 for the growth rate, all right? And the stock price, again, we take the dividend divided by the capitalization rate at 15%, okay? What is the market capitalization rate? It means that if you invest in the market, that's how much of the rate of return that you should have, okay? So market capitalization rate, 15% minus the growth rate of the firm, at 12%, so the stock price should be at 26.67, okay? And then you can compare how the stock price is from the equation compared to how much it is really right now in the actual market, okay? And the price to book ratio, 26.67 divided by 10, okay? Divide 10 because it's the book value per share that we have from the question itself. So it's 2.667, okay? That's for firm A. Now, for firm B, the ROE is actually at 15%. So it means that each share, the firm will be earning $1.5. The dividend, 1 minus 0.6, whatever is left over from the retained earnings, okay, with the plowback ratio, will be 1 minus 0.6 multiplied by 1.5, we'll have 0.6. The growth rate, again, we take 0.6 multiplied by 15% of the capitalization rate, that'll be 0.09. Stock price, now we have figured out it should be at $10. So we take 0.6 of the dividend, divided by 15% of the capitalization rate minus 9% of the growth rate, okay? That will be the margin, okay, expectation between the firm's growth rate and the capitalization rate, okay? So the price book ratio will be 10 divided by 10, then we have 1.0, okay? So this is to show you how we can use the price to book ratio compare in accordance with all the different ratios that we have for the ROE, for the dividend, for the growth rate, and for the stock price. Now, we also have the PE ratio, okay? In addition to the book value ratio, we also have the price earning ratio, okay? Price earning is the market price of a share of a firm's common stock divided by its earnings, okay? Right, so what does it indicate? It means that a low PE stock will allow you to pay less per dollar of current earnings, okay? But that also, include the market expectation. How does the market see the future prospect or the future earnings capability of the firm. Okay, so usually investors might take it, if a firm has a high P ratio, it will be a worth investing firm. Okay, compared to a firm with a low P ratio, investors might be a little bit cautious. Okay, because no one wants to invest in a firm with a low earnings prospect. So a high P ratio may still be a better bargain if its earnings are expected to grow quickly enough. Exactly.